Hello, this is Tony from TFS Forex Academy. So this video I'll be talking on candlestick patterns. Okay, so let's get back to our guide. Our guide is this book called Naked Forex. I told you guys to read it. Okay, Naked Forex. Please go and read it. I won't waste so much time on this. Okay, so I'll just highlight some basic candlestick patterns to look out for. Reversal patterns. Okay, first of all, so today we'll be looking at the market candlestick patterns and how the market normally moves. Okay, so let me demonstrate with my marker. How does the market move? Therefore, the market moves like this. An uptrend, when you are in an uptrend, you have high, higher high, higher low, higher high, higher low, higher high, higher low. So this is an uptrend when the market is in an uptrend. Now when the market is in a downtrend, you have something like this: lower low, lower high, lower low, lower high, lower low, lower high, lower low. Okay, so some people call this impulse leg correction, impulse leg correction, impulse leg correction. For an uptrend, this is an uptrend. In an uptrend, this is how the market moves when you are in an uptrend. So you always have impulse leg correction, or we call it pullback. Impulse leg correction, impulse leg correction. Then if the market is in a downtrend, this is how it's gonna move. In a downtrend, you have impulse leg correction, impulse leg correction, correction, impulse leg correction, right? And I have another one, impulse leg again. So this is the basic market structure, right? Now as the market is moving, these areas that the market pauses, this area, these are swing points. Swing what? Points. Here, here, and here, right? All right, so now okay, so now I want to show you something very important. Now when the market, assuming that this is an uptrend, when the market moves impulse and it will now correct, right? Impulse again is going to correct somewhere here. Watch carefully. Then impulse again corrects somewhere here, and then it can now reverse using head and shoulder pattern or Quasimodo or M and W. The market will reverse. Now watch this carefully. You see that this area that the market halted, stopped at a pause, and initially, watch, the market respected it. The market has memory. Again, this area that the market had a pause again, in future the market also has respected it, right? So, and then here it's now reversed. So this is what I want you to understand. These areas are temporary resistances that are being blown out. Okay, so when the market has a impulse here and corrects here, and then you have under impulse up move, you wait for the market to come down to this level again and retest this zone. So your entry point should be somewhere around in this zone. I don't know whether I'm clear on this. Resume. Alright, so now here is what I'm saying, in case you didn't get what I'm saying before. Now in an uptrend, when the market is moving in an uptrend, you have impulse, correction, impulse, correction, impulse. How do we know when to enter the market? Remember, all these areas are swing points, swing points, swing points. Okay, now when you have this first leg impulse and you have a correction here, right? Now this is our low, this is our high, this is our higher low, and this is our what? Higher what? High, right? Now what I want to teach you is that when you have this structure, low, high, higher low, and higher high, you have two consecutive legs that have been the market has given you the structure for an uptrend. Now our entry should be in this zone, this area where price has been respected. This area, this zone here should be our entry, because the market has respected it on the first leg and then broke it. This is also what we call the breaker for those that will be joining our advanced class. Okay, now let me just, for emphasis, let me illustrate with a downtrend. When we have a downtrend, in a downtrend you have market has been going up, and then you have your M and W for the market to reverse. You now have impulse, correction, is the first area of correction, then you have under impulse again, correction, you have impulse. Now what I'm saying is this: identify the swing points here, extend it, okay. So this is the impulse leg 1, and then you have the impulse leg what? 2, right? So when the market had, so this is the structure of downtrend. You have a low, a low. So you have a high. This is our high. This is our low. This is our lower high. And this is our lower low. So market has given us confirmation that it wants to continue the downtrend. So we have to be patient. Our work is to be patient. Most times we lose money because we are not patient. Allow the market to give you this structure to confirm the direction of the trend. You must have if it's a downtrend, you have a high, a low, a lower high, and a lower low. Now identify this swing point here, this price region here. When price comes up to this region, this is your entry rule. Okay, your entry. So when price comes to this area, this is when you can enter the market and ride the trend. This is trending in the direction of the trend. Okay, so alright, so that was the first thing I want us to learn in this video. So let's move next to the candlestick reversal candlestick patterns that we can use to take these threads. Alright, so now let's look at the reversal candlestick patterns. Just download this book from the internet, type it in at internet, the goldandoilguide.com, candlestick descriptions.pdf. Okay. All right. So now this is a description of a typical candle. A candle has the for a bullish candle. Bullish means when the market is going up, right? Okay. So for a bullish candle, the market opens below and closes on the upper side, while for a bearish candle, the market opens on the upper side and closes what? Below, right? Now there are candlestick patterns that we normally look out for to gauge that the market wants to reverse. The first one is the doji candle. The doji candle, you will see, first of all, let me just explain how does the market reverse. Okay, let me just explain something. In the anatomy of candlestick pattern, I'll just teach you two, or at most the three common ones. Okay, so the first one I want to teach you is the pin bar. This one, or rather, let me use a very good color to represent it, because I normally use a red color for bearish candles. So you have the pin bar. If the market is going up, and then you now see something like this, a pin bar, a candle with, okay, a red candle like this, that's a pin bar. Then you see something, a green candle like this, as a pin bar, a pin bar. Now I will send more details of the rules for illustrating pin bars. Okay, now this pin bar occurs at the end of an uptrend. Okay, higher high, higher low, higher high, higher low, higher high, higher low, higher high. Okay, and then you now see the pin bar right on that zone. Why the green pin bar too occurs at the end of a downtrend. So you have higher high, higher low, sorry, lower high, lower low, lower low, lower high, lower low, lower high, lower low, and then you see a pin bar. Okay, so the anatomy of a pin bar, what it means is that, let me draw a pin bar here. A pin bar, what does it tell you? A well-formed pin bar. Like I told you, for a bearish candle, the price opened here and then rose all the way up. The buyers took the buyers took the market all the way up, right? Okay, then the sellers entered and the market closed at the low side. Let me come back again so you understand what I'm saying. What I'm saying is that for a red pin bar, for a bearish pin bar, this is what it looks like on the charts. On the charts, it has a long wick, at least the 2/3 of the body is a wick. When you see something like this on H4, we identify it on H4 time frame, and sometimes also on H1 time frame, that's 1 hour time frame, and on then D1 1 hour time frame. Right now, what does this thing tell you? What happened here? Like I told you, for a bearish candle, we have the opening price opened here. Okay, and then it closed lower. It closed lower. That is for a bearish pin bar. Okay. Then, but for a bullish pin bar, is something like this. Okay. For a bullish pin bar, it's opened here. It's opened here and then closed on the top here. It's closed on the top here. So what I am actually saying is that, what if you are asked to explain what actually happened? What happened here is that the market, the market, if you go to lower time frames, the market opened for a bullish pin bar. The market opened at this point, okay, X, and then the sellers, sorry, the market opened here. Now the sellers drove the price down, right? The graph down, and then the buyers now did what? Enter the market, now reverse the market, and even close the market higher, telling you that the strength of the buyers is more. While in this area, the market opened here at this point, the buyers entered the market and drove the market up, but the sellers now did what? Overcame them and drove the price down here. Then the next candlestick reversal pattern that I want to teach you is the morning star and evening star, which is also similar to the pin bar. Okay, so market has been going up, making higher high and higher low, and then somewhere here you see the morning star. The morning star simply means you have a green candle, a bullish candle here. Then you have a doji, an indecision candle here, and then followed by what? A bearish what? Candle. This is the evening star, telling you that the market wants to go what? Down, 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 down. What I'm showing you are just the most important reversal candlestick patterns. I don't care about many others. Okay. All right, so let's continue. Then in a downtrend, when you are in a downtrend, market has been making lower low, okay, so lower low, lower high, lower low, lower high, and then towards the end you have this big bearish candle, then followed by an indecision candle, and then after that you have the bullish candle. So the psychology behind it is that the sellers drove the market low, and then you have this short candle, this very thin candle like cross, okay, is an indecision. The market doesn't know whether should I go down or should I go up. So after the struggle, the buyers enter the market and push back the market, retrace it back to 100% or more. So that is your evening star, evening star. So when you see this after the end of the trend, it means that the market wants to do what? Reverse. Okay. Then the last candle stick pattern that I want to show you before I round up this session is the bullish and bearish engulfing candle. Just these three is enough to set you to be profitable, right? All right. So now, for bearish engulfing, higher high, higher low, higher high, higher low, higher high, right? Now here you will now see, after your bullish candle, you will see a bearish candle, a big bearish candle here that overcomes, that takes away the total efforts of the buyers. When you see something like this at the end of an uptrend, a bearish candle that covers completely the bullish candle, that means that the momentum for the sellers is very, very high, and the market is ready to do what? Go down. Now, as the market is going down, you now at a stage you see this bearish candle, and then you see a bullish engulfing candle, a bullish engulfing candle that takes away all the efforts of the sellers. So this also tells you the market wants to do what? Reverse. So after that, you start seeing higher high and higher low. So that is the these are the my three major candlestick patterns that I normally use. There are many others which you can just speed up. I cannot teach you everything first, but thank you and God bless you. Okay, so if you want to enroll in our basic and advanced class, you can chat us up on WhatsApp and we'll get you started. We'll have one-on-one training or a live training depending. Okay, so so I think I will be stopping this video at this juncture. This is we'll continue the basic class, introduction to forex, candlestick formation patterns, common patterns, fundamental analysis, and basic technical analysis. These are all the free. Will be free. The training will be free. Okay. Then you have the intermediate class, which will be a paid training involving the use of indicators, money management, trading psychology, and all that, and there are so many other things. Then you have the advanced class, where we'll be introducing the order block, order flow, institutional order flow, the supply and demand. We'll talk about the Wyckoff model. We'll talk about the Falcon strategy. We'll talk about the market momentum model. Okay, so there are many other things. So, but if you're interested in registering in the intermediate and advanced class, you can chat us up on WhatsApp and let us know. So thank you and God bless you. We'll see you next weekend.